There's a version of your life where the income is fine. Not spectacular maybe, but enough. Enough that you should feel further along than you do. Enough that when you check the account mid-month and it's already thinning out, there's this quiet, uncomfortable moment where you do the math and it just doesn't make sense. You earned that. Where did it go? That question is the whole thing. And the reason most people never answer it isn't intelligence, and it isn't income. It's a loop, a quiet one. It goes something like this. Money feels stressful, so you avoid looking too closely. So the defaults take over and run your spending for you. So nothing changes, so the stress compounds, so you avoid it more. The loop protects you from short-term discomfort and costs you everything in the long run. What we're going to do in the next few minutes is name 8 specific habits that live inside that loop. Not to shame anyone, these habits feel completely normal from the inside. Most of them feel responsible, but they have a quiet cost that only becomes visible when you're willing to look. And that one act, just looking, is the first move that starts to break the whole thing open. The first habit is the root of almost every other one on this list. It's not tracking. Not in a spreadsheet obsessive way, not in a complicated way, just not knowing with any real clarity where the money goes each month. And it feels fine day to day because the card works, the bills get paid, life continues. The avoidance isn't dramatic, it's just a tab you never open. The mechanism here is protection. If you don't look closely, you can't be confronted by what you find. But what that protection actually does is hand your financial life to defaults, subscriptions auto-renewing, spending patterns running on habit rather than intention, money evaporating in amounts too small to feel significant and too consistent to ignore. The micro-action is simple. 20 minutes, last month's bank statement, 5 categories. Not to judge what you find, just to see it. Observation without judgment is how you start building a new relationship with the numbers. That's it. That's the first move. Seeing clearly is the beginning of everything. The second habit is lifestyle inflation, and it's invisible specifically because it doesn't feel like a mistake. It feels like progress. You earn a little more, you spend a little more. The apartment gets nicer, the car gets newer, the takeout gets more frequent. Each upgrade feels deserved, and individually, each one probably is. The problem is they move together, silently, so that the gap between what you earn and what you keep never widens. Income goes up, lifestyle follows immediately. The number at the end of the month stays flat. The identity loop here is straightforward. Spending at a certain level starts to feel like evidence of your status. Scaling it back feels like regression, not strategy. The reframe is this. A modest, intentional lag between earning more and spending more is one of the most underrated financial moves available to an ordinary income. When a raise comes in, route the increase before it hits your lifestyle. You never feel the absence of money you never spent in the first place. Lifestyle follows income only if you let it. Third is what you might call leftover savings, the approach where you spend the month, cover the bills, and save whatever happens to remain at the end. The issue is that in most months, nothing remains, not because you overspent dramatically, but because spending expands to fill available space. It's not a discipline failure, it's just how unmanaged cash flow works. The shift is routing. Before the money has a chance to be spent on anything else, a portion leaves for savings automatically. For example, even 5 to 10% on autopilot from day one changes the math significantly over time. You adjust to the lower available balance within a week or two, and the savings accumulates without requiring a monthly act of willpower. Automate the routing. Let the system do the work. Pay yourself before the month can spend it for you. Fourth is normalizing a carried credit balance. This one has cultural cover. Nearly everyone carries one, which makes it feel like a reasonable financial tool rather than an expensive one. But consider a hypothetical. A $5,000 balance at around 23% APR generates over $1,000 a year in interest on a balance that's doing nothing for you. That's money routing directly away from every goal you have, month after month, automatically. The identity loop here is that carrying a balance feels like managing, not struggling. You're making payments, you're not in default. It feels controlled. But minimum payments at high interest rates can stretch a modest balance into years of cost. The micro action is to find your current rate, calculate what the interest actually costs you monthly, and name it as a line item. When the cost becomes visible, the priority changes. Interest you're paying is a habit with a price tag. Fifth, no emergency buffer. Not a small one, not a building one, just none, or something so thin it wouldn't survive a single real expense. One recent survey found that roughly 43% of Americans couldn't cover a $1,000 emergency without borrowing. That number sounds alarming until you realize how easy it is to land there. A few years of saving last, a few years of lifestyle following income, and suddenly the margin is gone. The cost isn't just financial, it's psychological. Operating without a buffer means every unexpected expense is a crisis, and crisis decision-making is expensive. Reactive choices cost more than strategic ones almost every time. The starting point doesn't need to be 3 months of expenses. It can be one unexpected car repair. Pick a number that represents your most common emergency, open a separate account, and start routing towards it. Small buffers reduce panic. Panic is expensive. A buffer isn't a luxury, it's operating capital. Sixth is procrastinating investing, and this one has a real cost that's worth making concrete. Imagine two people. One starts putting away a modest amount monthly at 25, the other waits until 35 and puts away the same amount. By retirement, in many modeled scenarios, the 10-year head start creates a gap that no amount of catching up fully closes. The math isn't magic, it's just time doing what time does when returns compound on returns. The reason people wait isn't laziness, it's that investing feels like something you do after you have your finances figured out. But waiting to be ready is itself the delay that costs you. The micro action, if your employer offers any tax-advantaged contribution match, contributing at minimum to capture that match is often the highest return financial move available to you. If no employer plan exists, opening an account and making one small contribution breaks the psychological barrier. The amount matters less than beginning. The cost of waiting is not neutral. Seventh is ignoring tax-advantaged options entirely. This is high level and worth keeping simple. Certain account types allow money to grow under different tax treatment than a standard account. The specifics vary and depend on your situation. This isn't tax advice, and your circumstances matter. But the habit of leaving these options unexplored because they feel complicated is quietly expensive. The micro action is 1 hour of research, or one question to an HR department, or one session with a fee-only financial professional. You don't need to become an expert, you just need to know whether you're leaving options on the table. Complexity is not a reason to leave money unprotected. Eighth is focusing entirely on cutting spending when never addressing the earning side. This isn't hustle culture. There's no grind required, but there's a ceiling on what optimization alone can accomplish, and a floor below which cuts become unsustainable. In pattern after pattern, people who escape the tight despite good income feeling do it through some combination of reducing leakage and increasing what flows in. A skill investment, a credential, a repositioning in a current role. The earning lever is real, and it's available to most people, but it gets ignored when the entire focus is on the budget. Both levers exist. Use both. Here's where this lands. Every habit we just covered is connected to the same identity loop. The sense that you're not a money person, that this stuff is for other people, that looking too closely will only confirm something uncomfortable. That loop is a feeling, not a fact, and it breaks the moment you make one small act of engagement. Pick one thing from this list, just one. Set an automatic transfer, even a small one,
For example, 5 to 10% route it out before anything else moves, or spend 20 minutes categorizing last month, no judgment, just categories, or calculate what 1 month of your essential expenses actually costs, and let that number be your first savings target. One action this week changes your self-perception faster than any amount of planning does. You now know what to touch first. Drop a comment with the one action you're choosing this week, not for accountability, just because naming it makes it real. And if this kind of clear, practical breakdown of how money actually behaves is something you want more of, subscribe. There's more coming, all built on the same foundation. This is a learnable skill, not a personality trait. You're becoming someone who handles this well. That starts exactly where you are.